Now that you know your total addressable market, your SAM and SOM, now you can start with a forecast, right? So the first thing that you would have to ask to create a budget is, let me see the budgeted sales. Or do you have any way to figure out how many sales you will do? Yes, based in the past, but at the end, in organizations, you have to ask which one is the responsible for doing the sales, right? And he's the one that holds the obligation to achieve those sales. So it's very common that you won't have to do a forecast or a projection regarding the sales. They should be based in a commercial aspect, and if they don't have it, at least they should be based in your market study. Yes, when they do, when the commercial teams they do their projections, they are commonly based on past data. How can you forecast from past data movements that could be potentially, instead of doing this sustainable growing rate, what if it should be more like, does your forecast would be accurate if you are basing your decisions on past data? Now you start to figure out the importance of this line, and as we show in the sales-based forecasting, the sales line was basically everything, the most important line that we needed to figure out. So now that we've seen scenarios, one of the scenarios would be if we can chart or plot, and that we will watch it later on the lesson. If you have a profit chart, which is could be time, and this could be profits. No, sorry, profits and quantity, not time. It's quantity. Sorry. So, what if profit, and this could be losses also, if you have a zero in here. So wouldn't you like to know this volume of profits? Wouldn't be this line having a relation with the level of sales? So you would have, you could potentially know what's the amount of quantity, product, or services that you need to give in order to don't lose. Does anybody knows or have any idea of how can you define the break-even point? And the most important aspect in here, guys, and that's why we do all the formats in the P&L that you wouldn't, didn't you ask before, like to yourself, why we have to do this format in the P&L? What is the purpose? Why we just don't we just like put income and expenses and that's it? And this is what you earn. Because at the end, from an economics perspective and from a financial perspective, what you're trying to watch and what you're trying to be very careful is with your variable costs. So if you know that, what is the contribution margin, guys?
Total revenue less variable cost divided by total revenue.
Be careful. It's the minus cost, not variable cost. Yes, income minus cost gives you the margin. So this is the contribution margin, guys. Now that you know that this is a 30%. of contribution margin, then what comes next? Fixed, no? No, the expenses, sorry. We know that the equation, it's income minus costs, gives you the contribution margin, and the contribution margin is, in order to know this percentage, what is the equation?
You must divide by income.
Perfect. So you have that your percentage of margin equals contribution margin divided by income, no? Sales. Let's call it sales. This function it's very well related to what if we want to know what's the amount of sales in order to get what it's you don't know the sales, you put it as an X variable, because what you want to do is to equals the level of contribution margin to your expenses. What would happen if we equal the level of contribution margin to the level of expenses? What would be your net profit?
0.
So if you know that you have this equation, what equation will give you the level of sales, which is the variable that you don't know? That's what you want to know to get a break-even point. This is the variable. You are able to know the amount of expenses that you would have. How you can budget expenses to get to certain level of activity without even knowing the volume of sales. You can use past data to know the level of expenditure. Sorry, expenses. I'm speaking regarding expenses. You could budget expenses without knowing the level of sales. You can use past data to budget the level of expenses. So what would you do in order to know the sales variable? You know this one and you know this one. You know that this is 30%. Forget if you know the contribution margin. Assume that you know it. Assume that it's 100 and assume that it's 100 of expenses, because that's the break-even point.
You'd multiply by the reciprocal, so then it would be sales equals expenses over CM, contribution margin. No, sorry, it would be the other way.
CM over expense.
Yes.
Forget it, guys. You don't have expenses because that is equal. You know that you need to equal that. So you just know that the contribution margin should be or must be 100. And you have this equation. What would you do?
333.
How did you get it?
So I isolated sales, then I substituted 30 and 100, and I just divided.
Just be very careful if the fixed components of the cost are very representative. As you saw in the cost process, they were not that representative, so that's why you move them to conversion costs. But the basic formula is the total of fixed expenses or fixed components divided by the contribution margin of the variable costs of your products or services. So in this chapter, as I told you, we will review the cost volume relationships, which is called CVP for short. We're going to put together some concepts about cost behavior, what we learned the whole semester, and use it to guess and predict how changes are going to affect our financial statements. So First, a few assumptions. To simplify CVP calculations, managers typically adopt the following assumptions. So remember, in managerial accounting, it's okay to make some assumptions. We are more concerned with relevance and timeliness than we are regarding precision. More than precision, I like to use the materiality concept. Number one, selling price, it's constant. So we can choose to make changes to the price, but overall the price of the product aren't going to change as volumes change. Or if you think about like gas prices, they change constantly, right? So we have to make the assumptions that the selling price of our product is constant unless we make a management decision to change it. Number two, costs are linear and can be accurately divided into variable and fixed components. When we see mixed costs, you know it's your job to break it into variable and fixed. The variable costs are constant per unit, and the fixed costs are constant over the total entire relevant range. Finally, number three, in multi-product companies, the mix of products, or what we call the sales mix, remains constant. So for most of this lecture, number three is kind of irrelevant. Then we talk about sales mix at the end, so don't worry about that. First, we're going to be looking at contribution margin and how changes in activity level are going to affect our contribution margin, and net operating income. We're looking at this income statement, very basic in some income statement for a racing bicycle company. And we see we have sales of 500 bicycles. That's $250,000. So we could figure out the sales price per bicycle by dividing by 500. And then we've got our variable expenses at 150,000, our contribution margin or 100,000, fixed expenses 80,000, the contribution minus the fixed expenses gives you the net operating income of 20,000. Because we are using the contribution format, we have arranged our expenses by their behavior. Be careful using the proper financial statement, because you don't want to mix fixed components into the costs. You will have to analyze fixed and variable components. From a sales perspective, your product, your activity is viable. Now that you got your market and your forecast regarding the sales, and you know that the market size is that enough for you to have a proper project, what you just do is do all these variable costs definition, because at the end, for example, if you have expenses like the office rent, like the salary of the employment, I don't know, office supplies, guys, those are components that you can't remove from your companies. If you don't sell anything of in your company, you would have to pay the payroll, right? You have the obligation to do that. You will have to pay the office rent. So now that you know that those are the fixed components, what you're trying to achieve is, okay, I know my fixed components. I know that the market size is very big, and it's just a matter of knowing the level of sales to break even. So if you have a company like bicycles, what would you think if, in order to break even, I need to have or need to sell 1 million bicycles? What would you think?
Assuming it's a bicycle company just in one country, it's a very small number of people actually buy, well, not luxury, but a sort of expensive bicycle. So 1 million of those would be pretty hard to sell.
Exactly. Those are variables that you have to figure out. What if I would tell you that that level of sales compared to your competitors would put you in the top 10 companies of bicycles in Latin America?
Depends where we are. If we are a small company and we suddenly make a jump,
Exactly. What if I tell you that to break even, you only need 400 bicycles? Achievable.
Yeah.
Achievable. Yes, and that penetration ratio into the market would put you with a penetration of maybe 0.5%. From the 10 Samsung, you only need the sum to be 0.5%. Oh, maybe it's not that hard to enter to that market. Obviously, we are just break-even point. That's a break-even point. We don't know if from the shareholders' perspective, they want to be the top 10 bicycle company in Latin America. We're just discussing what are the basics in order for your business to be profitable. We arrange it based on cost behavior. The contribution income statement is helpful to managers in judging the impact on profits of changes in selling price, cost, or volume, which emphasize being on the cost behavior. The contribution margin is the amount remaining from sales revenue after variable expenses have been deducted. Do you see the difference between the P&Ls that we've seen and this one?
we don't divide variable expenses and fixed expenses in the same way that they do.
That's one. And take a look at the table. What else will you have?
Per unit basis.
Per unit basis. Excellent. So under this contribution approach, here's where we get to the answer to the whole chapter, okay? Sales variable and contribution margin can also be expressed on a per unit basis. So over here, they told us that we've got 500 bicycles. These sales are 500 bicycles. So we divide by that each of these figures, 250,000 divided by 500 bicycles, it gives you to 500 per unit, no? And the dividing variable expenses per 500 units, it gives you the 300. And now you know per unit the contribution margin. To get to know which is your contribution margin per unit, that's why we change it. We change the approach when we are speaking regarding financial information. We modify a little bit the presentation in the income statement, because at the end you don't want to mix variable and fixed expenses. Why? Because fixed expenses at the end, it's what we economists and finance guys know as don't spend expenses, which is basically you don't take them into consideration into certain point. As we saw this bicycle example, now you know that you need 400 bicycles to sell, and I didn't took into consideration the expenses in there to do my analysis. I just know that I know the 400, and based in that, you can potentially start conclusions with regarding the structure of expenses is appropriate to the level of break-even sales that we need. Or maybe if you want to achieve the 1 million bicycles, you will need another structure with another amount of capital and resources in order to achieve those. So RPC, this racing bicycle company, must generate at least $80,000 in total contribution margin in order to break even. That just put us on zero, as I told you in the first example. So in order to get break even, you will have to equal the contribution margin to the fixed expenses. So you need an 80,000 of contribution margin. So who can do the math in this example? Level of units that I need in order to achieve break-even point. What's the level of contribution margin that you need in order to break even? Yes, 80,000. You just need to equal this contribution margin to the fixed expenses to get zero. If we know the level of contribution margin that we need, how much units would I need in order to get 80,000 of contribution margin?
The 400, because you divide 80,000 to 100.
And I wouldn't need even the units per units thing. Eh? What if you don't have units? What if you sell services? You wouldn't be able to get your break-even point. So what we do, how do you get the contribution margin percentage? Please tell me what's the contribution margin percentage. 40%. Fixed expenses, which is the same as the contribution margin, the same thing, but you can use fixed expenses divided by 40%. You know that it's 40% of contribution margin. That means income minus variable costs. Remember the first equation that I gave you? That contribution margin equals fixed expenses. So you can put fixed expenses divided by the contribution margin percentage, obviously, the percentage. And what is the result? Dividing the fixed expenses by the contribution margin percentage will give you the level of sales that you need in order to get the total amount of contribution margin to equals the fixed expenses.
So would it be 200,000?
Exactly. But that's not the answer in units. Who can give me the answer in units? 400. What did you do? Did you know that in this contribution income statement for 500 bicycles per unit price is 500. So you just divide the 200,000 that Andrea told us by the 500 and it gives you the 400. So basically it's another way to do it. Another way to do it, but my way applies to everything, not only to products. If you want to do it in this way, you will have to have products. Take a look at the contribution approach. Yeah. It's putting it the same way, just in a equation form. It's the same. It's totally the same. In an equation form, it's telling you the profit is equals sales minus variable expenses minus fixed expenses. What if you sell 1 unit more above break-even point? What would happen? You're earning money, but for the total amount of 1 per unit, no? And what if you sell downwards or 1 minus break-even level of volume per product? You will lose the contribution margin per unit. It's the same thing, totally the same thing, just in an equation thing, This will show you guys, this learning objective will show you how to interpret a cost volume profit CVP graph and a profit graph, like data visualization. Do you know anything regarding that? So yes, I like this type of charts. In a CVP graph, unit volume is usually represented on the horizontal x-axis and dollars in the vertical y-axis. So if you graph fixed expenses, guys, obviously it is, we're watching the whole, not per unit thing. This is the whole company's graph for fixed expenses because obviously they are fixed, so it's just a linear amount. It doesn't changes with the volume. Okay, you always pay like 80,000, and obviously you start from in the costs, in the variable cost section, you start since the minimum price, since the minimum cost that you will, even if you don't sell, you start by having costs of 80,000. Okay, so that's why you start in this point, and then you start graphing like we saw in the charts previously, that in a global perspective from the company, the cost, but the variable costs, it's a linear function. More cost, more production, more production, more cost. So choose some sales volume, says 400 units, and the point representing total expenses, fixed and a variable. And this is the fun part. This is the profit line, the sales line, the sales line. So what conclusions you can offer me, your executive, your C-suite level executive, from these charts?
Like I observed that what we just sold, like about the 400 and the 200,000 is at the point where sales and total expense and like get together in the lines. Yeah, intersect. And so I believe, I don't know, that would be the point, the breaking point.
What is this? Yes, you're totally correct, Andrea. That's the important conclusion. What is this point where it's the sales intersect and the total expenses intersect? It's where the contribution margin equals the total fixed expense, right? And this is what the conclusion, which is correct. If you graph that instead of sales, you graph the profitability of the company, that it's obviously a parallel line to the sales. At the end, you have what's the level in this graph, which is a profit graph. What is the level of number of bicycles sold in order to achieve zero profitability?
400.
It's very easy, guys. This was the contribution margin break-even class. Now you know from your syllabus how to break even